Hey everyone, in today's video, we're going to be going through 5 Canadian dividend stocks that have been killing it so far in 2024. 4 of these 5 dividend stocks actually have pretty low starting dividend yields, but they increase their dividend very quickly. And then the 5th one has a really juicy dividend. So we're going to go through these one by one, looking at their year-to-date performance, a bit more background on their recent business performance, and then also look at their current trading multiples in terms of price to earnings and where they're coming from as well. So we're just going to jump into this one. If you like this kind of content, be sure to give this video a big thumbs up. Helps a ton with the channel. The first one, as you can see on the screen, is Dollarama. Dollarama long-term has been going on an absolute tear. Last 5 years, they've been growing like crazy, hand over fist. Stocks up 200%. Year to date here, the stock's already run another 10%. And for a reminder, for those of you maybe not watching this video right away, we're about mid to late February. So just 2 months into the year, Dollarama up another 10% here, right around its all-time high. If you take a look at their 52-week range on the right-hand side, $30 billion company. So you think of Dollarama in comparison to lots of other retail stores in Canada, like a Canadian Tire maybe, or a Metro or something like that. This is one of the largest retail stores and businesses in Canada, maybe second to Loblaw. But other than that, when we look at stores like Metro, just taking a peek at their market cap here for comparison, and Metro owns other banners under it, but Metro is only $16 billion, so it's 2 times the size of Metro. If we were to go and take a quick peek at Canadian Tire, there are also multiples of the value of that company there. So Canadian Tire over here is a company that is worth, hold for it, $8 billion, so about 4 times the size. So this is a giant company. Looking at how they've been doing. So last 12 months, almost $6 billion in revenue they have here. Really nice gross margins, 44% for a retailer there. This is partially because they don't really operate as a grocer. So it's not like they're selling really cheap items with low margins, lots of waste. They really focus on categories that are fast moving, higher margin, and that they can still offer good price points and get good gross margins on. The other thing, aside from their high gross margin, is their high growth rate. So trailing 12 months, growth rate of 20%. That's phenomenal for how big of a company Dollarama's grown into over the last number of years here. Taking a look at their store count, so about 1,500 stores. It's a massive presence across Canada. For comparison, I think Walmart has about 4,000 stores in the US, and in the US, they're within 10 minutes driving of over 90% of the population. So obviously Canada is not apples to apples market. We're a bit less densely populated. We have a lot of areas outside of the 6 cities that are harder to get to, so it's harder to do that analysis. But we're about a tenth the size of the population, and they have almost half the stores that Walmart has in the US, just to kind of help you think about how big and broad their presence is in the Canadian market. They also have ambitions to get to 2,000 stores in the next 6-7 years. So over the medium term, 30-ish% growth rate in store count. So in addition to growing organically revenue per store, they also have ambitions to continue to expand that store count as well as another layer of growth. One thing I just want to call out here, you'll see they also own, I believe, a company called Dollar City that they call out down here in Latin America, currently at almost 500 stores. So a big part of the business, almost a quarter of their store count, despite maybe not being a quarter of the operating profit just because of the economy down there relative to Canada. But that's a really interesting opportunity that they keep expanding and building out. Also looking at really driving a lot of growth there, 850 stores targeted there by 2029. Moving on here, back to what I was talking about before in terms of the categories they play in. You see no grocery or things like that here. You see a lot of seasonal. So if you go to Dollarama, lots of people go to Dollarama for cheap seasonal items for Easter, Halloween costumes, Halloween decorations, celebratory holidays like St. Patrick's Day, etc. So this is a really nice part of their business. On one of the other slides, I believe it's about 15% of their total sales actually, so a very notable amount. And then other forms of merchandise and consumables around confectionery, more snacks and drinks than grocery at the front. Things that don't necessarily expire right away or that cause waste or are extraordinarily low margin. More things that they're getting from consumer packaged goods companies like Hershey and whatnot. Continuing on with Dollarama here, this is similar to what we were looking at before with their 2,000 store goal, but it's interesting to see how fast they've scaled. 900 stores in 2009, they grew about 30% in 3 years. From 2009 to 2012, got to 1,200 stores. Then in 3 years, grew another 15-20%, and they've really been compounding that growth rate per store, opening over 100 stores or around 100 stores a year. And if I continue to extrapolate that out, the growth rate's slowing down a bit as they get less white space across the country, but still a really nice growth rate of expecting 30% growth in the next 7 years. So, 3-4% store growth a year in their network is being forecasted currently. And obviously, when you compound their revenue per store that they showed, along with the fact that they've just doubled their network pretty much, it's not surprising to see that the stock has just exploded since the IPO, up over 500%. You also start getting multiple expansion when you continue to deliver year after year, opening up more and more stores, driving more and more productivity, expanding margins, et cetera, et cetera. So this has been a huge success story. Seems like investors continue to bid it up in 2024 so far. Looking at the valuation, high side analysts expecting $4 a share, low side about $3.80. So if they do $4 a share, they're trading at about 26 times earnings. If they do the low side, closer to 28, 29. So this is definitely not a cheap stock to be buying on a relative price to earnings basis. Trades at quite the premium. You're getting about a 0.6, 0.7% dividend yield, but it has been going up. They do increase the dividend every year. It's just more of like a long-term one that'll compound over time versus a dividend yield that you can really get a juicy return from in the short to medium term. Going over into the second stock here, it is Manulife. So this is the one stock on this list that actually pays a really juicy starting yield of about 5%, as you can see here. Looking at this stock year to date, already up over 12% on Manulife. Insurance companies are really interesting businesses, obviously in the financial sector, but they sell a lot of life insurance policies, things like that, that they continue to collect premiums every month. And when interest rates are high, I was always under the belief that they do really well in high interest rate environments because they can invest those premiums that they're getting paid out month after month into higher rate treasuries and other income deriving assets. And they don't really have to pay out claims until down the road. So the more money, safe returns, risk-adjusted returns rather, they can get in the short term, it just explodes profitability. Looking at the stock over the last 5 years here, up 45%. So they've done very well, especially relative to banks in the Canadian market, which is an area that I have some investments in across a handful of Canadian banks. So looking back 5 years, I wish I had Manulife Financial. Instead, I'd be in a much better position. But I do really think that, at least how I believe, or I'm thinking of one of their biggest income streams being the income that they're getting off of those premiums. The higher rates for longer is actually something that benefits a company like this, at least in that profit center of their business. Longer term, you can see here going into 2008, stock was at about $40 a share, and it's actually reaching its all-time high since then. So highest it's been in over 15 years here, approaching the mid-30s. Taking a look at some of their recent performance, you can see here some of the things that are driving that share price up and up and up throughout 2023 and continuing over into 2024. You can see Q4 earnings accelerating 20% on EPS. For the full year, they actually grew 17%. So they accelerated in Q4, but delivered a really, really strong overall number. Their return on equity went up 200 to 250 basis points throughout the year, as well, as you can see on the right-hand side. Really strong numbers there in terms of the gradual increase into the mid to high teens. Love to see that if you're an investor. And then continuing on here, you can see some of their return of capital. So in addition to that 5% dividend yield, they're also paying out a nice chunk to investors via share buyback. So about a 5% dividend yield and about 60% of the value of that dividend in share buyback. So probably bought back about 3% of the company last year. When looking at their buybacks or their outstanding shares over the last 3 to 4 years, let's call it 5 years, they were at about 2 billion shares, and now they're closer to 1.8. So bought about 10% of the company in the last 5 years back for their investors, despite having that 5% dividend payout along the way as well. So these investors have done pretty well. This has been a pretty good risk-adjusted winner in the Canadian financial space. Looking at their earnings here, let's take a look to see how expensive they are. They have about $3.70 in the current year, which pins them at about 8.5 times earnings. Next year, they're expected to do $4 a share, which would have them about 8 times earnings. So these stocks are still cheap relative to the total Canadian market. Financials tend to trade in that 10 times earnings space or multiple range, so a bit lower than that. But insurance companies are a bit more one-dimensional than a broader commercial bank like Royal Bank or TD Bank, even though they do still do asset management and other things. Maybe they're getting a bit of a value cut versus the broader financial sector, despite the fact that they've outperformed greatly, just because their mix may not be as strong or as diversified as some other stocks in the space. But overall, under 10 times earnings has done 50% growth on stock price in the last 5 years, plus a 5% dividend, so about a 15% annual return to shareholders. Seems like a really interesting stock and one that's provided pretty good returns over the medium term. Going into the third stock here, it is Alimentation Couche. Couche is already up 10% in the last year. Similar trend with Couche here. In the last 5 years has been a great winner, up 125% here. What a chart here over the last 18 months or so, just up and up and up and up and up. But when I look at their multiple, which we'll get to later, it really hasn't expanded that much, which means that they are actually driving and compounding their earnings at a pretty high clip. It's not showing here, but I'm pretty sure they do pay a slight dividend yield similar to Dollarama. They increased it really quickly, but it's not too large of a dividend yield to start. Here, they're just showcasing some of their core brands, the Circle K brand that they're really trying to move into more and more as they buy new companies and they synergize. The Max Convenience brand and then Ingo as well. Going over into a bit more of their financial information here and company information, you can see that they have over 15,000 core, I don't want to call it chains, but core stations or gas stations paired with their convenience stores that they have here. About half of them in the United States, a couple thousand in Canada, 3,000 in Europe, a few thousand international. Overall, in over 25 countries, have a ton of business units under that as well. You can see here they're located in 47 of the 50 states, so very broad presence across America as well as Canada. Believe they are the biggest convenience store business in the world. I need to fact check that against maybe 7-Eleven is the only one that's making me a bit reluctant, but this is a huge company. Their market cap here, 80 billion Canadian dollars. So this company you see around in Canada, but they're really a global company. They have business all over the world. Just because they're incorporated in Montreal, I believe, doesn't mean that they're just a Canadian business. And one of the reasons or areas that they've grown is through acquisition. So they go into certain markets, they buy up chains, they move them over into Circle K or Max usually, and they just synergize lots of the private label products going into those stores. They do their layouts that are proven to work around the world. They use local market insights in order to drive growth, learnings from other comparable markets and whatnot. They drive scale on purchasing with vendors as well as fuel providers, as they're a really big gas business, given lots of their convenience stores are attached to the gas stations, so they get a lot of scale in that as well. You can just kind of see the total number of single stores and chains and stuff that they have the opportunity to continue to scoop up and take a bite out of. Over 60%, or around 60% of the chains are still one store, and then another 15% are under 100 stores. So this is a lot of opportunity for them to go in, make little tuck-in acquisitions there as well. Going into some of the areas they're looking at growing. So they're really focused on the entire experience. Obviously, the fuel side of it's a big part of their business, and that's one of the reasons I'm always hesitant about this stock. Don't know what the future of the fuel sector is, especially as lots of markets in Canada and the US try to pivot towards electric vehicles. Not sure if that's going to require heavy capex investment from them. It's one of the reasons that I kind of shy away from this one over the last few years. Obviously, it's been a missed opportunity given what the stock price has done, but it's still something that I'm a bit eerie of. In addition, in addition to that, they've also looked at how can they win in some of these other areas of their business. So they're calling out winning in food. They want a couple $100 million more in EBITDA through these food opportunities that they see, especially as people increasingly are eating on the go and stuff. People are going into these convenience stores pretty regularly as they gas up, as they're on the go. How can they capitalize on that store traffic in a bigger way with ready-to-go food? Winning in drinks. They do Slurpees and whatnot and some other offerings. So how can they better position that for growth? Those are pretty high margin areas of their business. And then winning in private brands. I actually noticed their private label exposure in my local Circle K. It seems like increasingly the store is less and less branded with national brands or North American, US brands, and more Circle K brand. And I'm sure the margins on those are much better. They get tremendous scale given the amount of stores that they own overall. They have a pretty nice opportunity here of over $100 million of continuing to drive that. Right now, only about a 4% penetration of sales, it seems like there. Looking at their EPS and multiple, this is what I was meaning to comment slightly a couple slides ago. But one of my concerns about electric vehicles maybe being a bit more prominent, and that potentially being a long-term either headwind or perceived headwind that trades the stock down. I believe that has held back their multiple a bit. They're only trading here at about a 17, 18 times next year's earnings, which is $4.60. Some analysts actually have them making about $5 or over $5, which would mean they're at about 16, 17 times next year's earnings. And given their track record of really strong growth, you'd expect the stock to actually be outpacing that. But I really do feel like it is their gas station exposure and their exposure to fuel that may be holding their multiple back a bit. So it depends if you believe in what you believe the future will hold in terms of gas, electric vehicles and whatnot, and how seamlessly they can pivot into electric charging, or if electric charging at commercial sites like that will be as prevalent as gas is today, or everyone will just have a charger in their own home, which would be a huge hit to a business like this. Going into stock number 4, it is Waste Connections. Waste Connections is a garbage company, $60 billion, so really big company here as well, that is incorporated in Canada, up 16% in the year-to-date look here. So just in the last 2 months, up 16%. In the last year, this one's up 25%. Last 5 years, this stock's doubled pretty much. So really great performance on this one too. Common theme on all these stocks is they've just been killing it, not just in February and January 2024, but over the medium term here. Similar to some of the other stocks like Dollarama, you're only getting about a 0.7% dividend yield here, but they do grow it annually, I believe, over the last number of years. So you will have to wait, but it hopefully will continue to go up in future years. This company here, taking a look at their presence, they are incorporated in Canada, but they are primarily a U.S. business here. They've made a lot of tuck-in acquisitions and strategic acquisitions in the U.S. to grow to that $60 billion market value, and that's how they have about 90% of their revenues coming out of the U.S. business. Canada is only about 13%. You can see all the different types of businesses, from landfill to intermodal to hauling, that they have across different markets. They're pretty much across the entire U.S., really populated here in Mid-America, also the Northeast as well, are areas that they have tons of presence in, but pretty broad performance there. In addition to that, these companies have just been compounding so nicely. You can see here, adjusted free cash flow, 2019, about $900 million. The pandemic year, maybe a bit of a drop off, but then back up to $1 billion, then $1.15 billion, then $1.23 billion. They just continue to go up and up and up for the most part. revenues as well, up and to the right. Everything else, pricing and whatnot, everything has been performing really well at a high rate of growth. And that's how these stocks are getting these kinds of multiples. As investors look at the glide path they're on and the opportunities they still have, they're saying, look at this stock, $5.50 in 2023 of earnings, $6.50 in 2024. That's a nice 20% bump. Now $7.40 in 2025. That's another 15-16% jump. If these stocks continue to grow their earnings at these rates, they're going to be worth a lot more in the future. And that's why it's kind of priced in to some extent. At $7.30, this stock's trading right around 30 times earnings here. So similar story to Dollarama in terms of valuation. So it really just depends if you even want stocks with this high price to earnings in your portfolio. And if so, what are you willing to pay that kind of multiple for? Seems like so far investors this year are willing to pay for these higher multiple stocks, as you're seeing lots of these higher multiple stocks jump up that are getting highlighted in this video. The last stock here is Loblaw. So I believe this may be the only retailer larger than Dollarama in Canada. $44 billion market cap. Everyone knows Loblaw. They own the Loblaw's banner. They also own No Frills, Real Canadian Superstore, tons of other banners like Zehrs and whatnot. They have franchise businesses. They operate IGA to some extent as well in a franchise model. And then they also have their direct businesses that they own, starting dividend yield of about 1.25%. And this stock is right at an all-time high here at $143. So far this year, boom, up another 11%. Seems like these stocks, these grocery stocks just keep going up. Last 5 years, 120% growth. It's been incredible to see a stock like Loblaw, who's had a lot of PR issues, a lot of pressure on their core consumers, kind of continue to go up to this degree. 120% in 5 years. It's like a 25% annual growth rate. And lots of that is driven by not multiple expansion, but actual more absolute profit dollars flowing to the bottom line. So really interesting to see them navigate that situation. But at the end of the day, these grocery stocks are essentially oligopolies in Canada. There's not many of them. So they're positioned really well to drive pricing power, to leverage their scale, to drive synergies, to optimize costs in order to drive EPS. They also do some share buybacks as well to drive these earnings per share numbers. But looking at their growth, $6.80 in 22, $7.60 in 23. So that's a nice double-digit growth rate. Then going $7.60 to $8.40, that's about a 10% growth rate there in the projections for next year. So if they actually end up doing $8.40 a share, that means the stock would be trading, doing some quick math, around 17, 18 times next year's earnings at $7.60 a share. That's closer to 19, 20 times. So under 20 times earnings in the outlook, despite this stock over doubling in the past 5 years, just goes to show the kind of earnings strength and earnings growth strength they've been able to flex despite the challenging times more broadly. They also have a pretty small dividend yield, a bit larger than Dollarama, Waste Connections, but they have been increasing it as well. You may not get as big of a dividend increase on these ones that are a bit more developed, but should still see continued growth as they drive earnings growth and whatnot, and continue to buy back shares to have more available cash per individual shareholder to fish out on dividends or other investments for those shareholders. So these are 5 stocks that have just done really well, honestly longer term, but more notably in this video focusing on ones that have done really well so far in 2024. Let me know if you own any of the stocks in this video, any other stocks that have just been crushing it in your portfolios lately. Would love to hear in the comments. Thank you guys so much for watching. Not a ton of people make it to the end of the video, so if you did, would really appreciate if you smash the thumbs up button. Helps a ton with the channel, and I'll see you guys in the next one. Thanks.